Acquisition Corporation would value WeWork at $9 billion, including debt. In 2019, WeWork was valued at $47 billion in a round of financing with SoftBank. The firm later had to rescue WeWork and now holds a majority stake. Shares of GameStop are still on a roll. The video game retailer is higher in pre-market trading after gaining 53% yesterday. Some of the other so-called meme stocks favored by investors on Reddit are also higher today, including AMC and Express. Global news 24 hours a day. I'm Ritika Gupta. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal time for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
These are highly progressive tax changes. Again, the president's goal here is to reward work, not wealth, to make sure that the corporates pay their fair share, and therefore no one with income under $400,000 sees a tax increase under the plans that are going to be trotted out starting probably next week.
Jared Bernstein there, the White House Council of Economics Advisors member. From New York City this morning, good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keane out of the building and back with us on Monday. Here's your price price action this Friday. Will look like this on the S&P 500. Futures inching higher on the S&P, up by around about 0.2%. The Nasdaq just dipping into negative territory as yields start to break out by 4 basis points on 10s to 167. In the FX market, euro still with a 117 handle against the dollar, a break of 118 in the past week. Euro dollar 117.77 and up 0.1%. And can we just round out the price action on this? Bitcoin year to date. And the reason I bring this up, year to date up by 83.64%, is because Troy Gayeski of Skybridge was just on the show about 5 minutes ago. And if you missed that conversation, here's a summary for you on his best macro trade idea. Bitcoin. This may be a year where success or failure may be determined by whether or not you had a meaningful position in Bitcoin. And then he went on to say, Lisa, similar to how 2007 success was driven by meaningful subprime short exposure. So the trade is one thing, but the amount this has built up in his overall portfolio to 13%, and he's not doing anything about it. He's just staying with this trade, Lisa.
Well, to me, this was a fascinating conversation. It went from about 5% in December to 13% now. That's what he said. To me, the idea that this is the biggest, most direct macro hedge, both on the debasement of the currency, both on the potential growth, on innovation, all of these aspects that he said that this is the key hedge, this is the key trade, to me raises a question about regulatory scrutiny and also what institutional investors are looking for to go on his same train. I mean, is that basically what's been driving the gains in Bitcoin? It's not the retailers, it's the institutions that are viewing this as the key macro bet, John.
How much volatility you're willing to tolerate, how much volatility you're allowed to tolerate in the portfolio. 13%, just unreal. What we're going to try and do, if you missed that, we'll try and get that out online as quick as possible on the Bloomberg terminal, and no doubt we'll try and lead with it on the podcast that gets released a little bit later this afternoon too. We need to head down to DC now to Kevin Cirilli, Bloomberg Chief Washington correspondent. Kevin, let's start with the news conference. I often comment on the news conferences for central banks because I've been in the room, the ECB, the Bank of England, many times over the years. For you, who have been in a room with the president before and asked questions, I want to understand from your perspective, just your assessment of the media's performance in that news conference.
I thought Justin Sink, our colleague, did a great job. I thought Kristen Welker's question of NBC News, where she asked for more transparency in terms of the horrific scenario, crisis is the right word for it, down at the U.S.-Mexico border. But I was struck that there weren't questions about unemployed Americans, millions of unemployed Americans. I was struck that there wasn't questions about workforce development for middle-aged Americans who are trying to find a job. I was struck that there wasn't a lot of questions about reopening schools. I thought it was a missed opportunity for the media as well as a missed opportunity for President Biden to talk about what he is doing to reopen the economy as well as to get the economy at a point that is more equal. I'm struck by this because they have done it, both of the two folks in that room before. Several of those folks have had that conversation with you, Jonathan, from the White House. So. Yeah. Rick Davis said it to me, and I thought it was brilliant the way he put it. He's our Bloomberg Politics contributor, and he said, that's what happens when you don't do press conferences, is you box it all up, and then it bubbles over. When you don't have a lane of communication, you can't expect but to have what happened yesterday happen.
So for the president then, you have to imagine, Kevin, if it's the media we're talking about right now, not the president's performance, then maybe he should carry on doing that.
No, I don't. I think it's a miss. I hear what your point is saying, but I think Rick, and in terms of talking with strategists yesterday, I think there were. I'm not sure you can drive a narrative that way. Is what I would. But hey, they've got a lot of strategists, so they don't need me.
It seems like, though, that there is a lot of popular support for Biden's proposals, and he was trying to use that and spin that forward to the infrastructure plan. Did he make any headway in either gaining popular support for his infrastructure spending or at least get fellow Democrats on board to push something through unilaterally?
There is definitely, and that's a great point, Lisa, because the president's stimulus proposal, as well as infrastructure, that polls incredibly high, as well as other economic policies. I think there are two dynamics, though, that were at play yesterday. One, from a policy standpoint, he's moved again away from the filibuster and in support of filibuster reform. That has wide-ranging implications for a host of policies that we talk about here. And secondly, his announcement, as I had alluded to, that he maybe is running for a second term. That also has implications in terms of the dynamic of his negotiating power, not with Republicans, but with his own party, who are now going to be wondering if he goes for a second term, will he be primaried? What type of Democrat will he be? Will they get any more political capital, the far left, in negotiating with him at a time when they're already frustrated with how the stimulus went?
All right, let's parse into the filibuster aspect. I'm sure we will be speaking extensively about the potential for Biden 2024 and that potential candidacy. There is a question of how far President Biden is willing to go, especially since this is the nuclear option when it comes to Senator Mitch McConnell.
Look, a filibuster, from a procedural standpoint, to dust off my 8th grade Schoolhouse Rock Live days, is a hurdle, and that hurdle presents itself to slow down the process in the Senate. And if you remove that hurdle, it will make legislation that moves in the House as well as in the Senate move incredibly quickly, and that will not just for his term, but for decades from now. So it would be the most significant structural change to order in the upper chamber in quite some time if it were to happen.
Kevin, good to catch up. As always, good to see you. Week's not over yet. Kevin Cirilli, Chief Washington Correspondent, host of Sound On. He'll be on Bloomberg Radio a little bit later on this afternoon at 5 p.m. Eastern Time. Lisa, a mile wide and an inch deep because the press had so many different things they had to touch on, and that's always the issue with these press conferences, and I think that's why it's part of the strategy in some ways. You wait 2 months to do a news conference. The press doesn't act as a pack and stick to one subject. It goes all over the place, and it allows you to stay about that deep and go a mile wide. And the only thing that we got from yesterday was just where the emphasis is, and we didn't get much on substance at all, and maybe that was the intention.
But honestly, that actually is really informative. The idea that Joe Biden is taking a much harder stance, and the filibuster issue is massive. Basically, for people unfamiliar, this is basically going to allow the Democrats, if they get rid of it, to go it alone with many more proposals, which could potentially make the government more effective, but also much more binary and flipping around depending on whether Democrats or Republicans are in power, John.
What happened to unity in D.C.? Hey, Lisa. That conversation.
Exactly. It was never there.
Exactly.
Come on.
I agree with you. I couldn't agree with you more. The idea of inviting Republican senators over early in your term to have a conversation about stimulus and then not really having any intent to have a real conversation about putting a package together.
Well, okay. In fairness, though, that when Obama tried that approach,
sure,
people accused him of not getting enough done. So Biden is taking that lesson, and he's applying it, and that's what we heard yesterday.
So don't waste time pretending you're going to do it. And I agree with you. That's where they're at now.
Fair.
I think the pretending has now stopped. They're not going to pretend anymore. They're going to be a lot more explicit about it. From New York City this morning, good morning. Equity futures up 7 on the S&P. This is Bloomberg.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
7:30 Eastern, 2 hours away from the opening bell in New York City. Good morning to you all. This Friday morning, here's the morning price action. Equity futures on the S&P up 0.1%. The Nasdaq rolls over, down around about 0.4%, but the Russell snaps back. It's not been about one or the other over the last couple of weeks. It's been about the weakness in both. We talked about tech, the stay-at-home names, DocuSign, Zoom, Peloton, and others really underperforming. Big moves off their 52-week highs that we've seen more recently, but a big move on the Russell since the middle of this month as well, down by around about 10% or so. We switch up the board and get to the bond market. We've asked this question through the morning. Robert Tipper-Pigeon will join us shortly. What is it about the 7-year? What is it about the belly of the yield curve that is so soft when it comes to auctions and supply? Robert Tipp's got his take. We'll get to that in just a moment. Yields are up by 4 or 5 basis points on a session. We do have a lift on 10s to 168, on 30s to about 240 now. So yields starting to drift higher. That curve starting to steepen out. No doubt Taylor Riggs and the team will be talking about the financials a little bit later. We'll get to that story too in just a moment. But finish on this. It has got to be the call of the morning. In fact, for me, the call of the last couple of months this year so far. Troy Gayeski of Skybridge coming on this show about 20 minutes ago and saying the fate of your portfolio essentially comes down to how you're positioned on this, on Bitcoin, up 82% year to date so far, up on a session by a couple of percentage points as well. And to such a degree, Troy Gayeski is now saying the fate of your portfolio is determined by this in the same way that your position around subprime in 2007 held the key to your portfolio then, 2007. 2021, that was a comparison I wasn't looking for. Bitcoin and subprime. Short subprime, long Bitcoin. More still to come on that. Taylor, what a call.
John, I knew you loved Bitcoin. Secretly, deep down, you told me yesterday you would never talk Bitcoin on the show. I knew it. It would come on a Friday. Let's get to some of the other movers that we're looking at today. Frankly, it's all big tech. I'll just recap sort of the key headlines that we got yesterday as tech tries to get a lift up today. Twitter, of course, saying they take some responsibility. Facebook saying blame the person, not the platform. Google trying to take that line as well. But really hard to see real legislation coming out of this. And so that is why you see calmness among big tech with the lack of a threat, perhaps, of further legislation. Let's go to other places where there is not calm. Let's take a look at day 2 Nike. John, yesterday, of course, big sell-off today, trying to recover from that sell-off with the boycotts in China, because really unclear what the fundamental change will be in terms of sales in China for Nike. Let's take a look at JP Morgan. You mentioned the financials, the Fed, 4:30 p.m. yesterday, saying that as of June 30, they can resume some of the dividends, the share buybacks. Cowen analysts saying third quarter, look for that to happen. It is coming. Finally, GameStop. You did Bitcoin. It means I get to do GameStop. 52% gain yesterday. We get a further lift up of 9% today. So you've recovered all the losses after the earnings report earlier this week.
Unreal. At least we spent a little bit of time talking about fundamentals and corporate strategy.
No.
Hey, Taylor. Didn't last long, though. Taylor Riggs, good to catch up. She'll be back on a close a little bit later this afternoon on Bloomberg Television. Look out for that. Let's turn back to this bond market. There is something about 7-year supply. A month ago, we had that terrible auction, but it was in the context of a really volatile week for treasuries, exacerbated the move, yields higher. This week, it was like we were almost set up for it. The treasury curve was firmer. The money came to market, 2s, 5s, the debt went away okay, and then 7s happened, and we were softer. Robert Tipp joins us now, PGIM Chief Investment Strategist and Head of Global Bonds. Robert, let's start there. What on earth is going on in the belly of the curve, Lisa? I think it's got to be a discussion that we need to have a whole lot more.
Yeah, because honestly, people had been expecting somewhat of a decline in demand. So it's surprising that even given that, John, even that, we saw that bid, that really weak bid to offer, or as Tom might say, bid to Negroni spread.
Bid to Negroni. Yeah, Tom called it. The bond market was a bit drunk yesterday too. Robert Tipp's back with us now, PGIM Chief Investment Strategist. Robert, well, I know we had a technical issue just then for a couple of seconds, so I'm not sure if you heard what we were discussing, but on the 7-year issue, the belly of the curve, what's happening there? What's the debate that's spilling over to supply, the uncertainty, the delicate dance that's taking place at the moment?
Yeah, I think it's just the uncertainty about the course of the Fed and the bulk of the issuance. I mean, the frequency with which the belly of the curve is getting hit, your 2s, 5s, 7s, your 10s, your 3s, every month Treasury pounding those parts of the yield curve in massive size. Different parts of the curve are just taking turns getting walloped because of the macro backdrop. Investors are afraid to step up and, evaluate what's going on in the world and feel like they're lying down on the tracks ahead of the inflation train that everyone is expecting. I think that's the problem. And that 7-year point is kind of an inflection point, on the curve, for maximum yield volatility, given the bulk of issuance.
Is it just an inflation story? Is it a Fed funds story too, Robert, for further down the road?
I think that the Fed, in some ways, is getting buy-in, and you have to dive into the yield curve. But when you look at the break-evens at the 5-year point of the curve coming up 270 basis points, what that tells you is people are pricing in success for the Fed in terms of achieving the inflation target, right? The market has increased yields a decent amount, and the market has its choice. Is it going to increase the inflation expectation component of treasuries or the real yield? And the real yield is incredibly low. And that reflects, in some respects, an expectation that the Fed will remain hold, keep the Fed funds rate incredibly low, and all of this expectation for Fed rate hikes and all that, what it really is an inflation premium in the front end of the curve. So I think, though, when you look, the critical question is the market usually right on that front? And the answer is it usually is not. And that creates the
so the market's usually... Okay, the market's usually not right on that. The opportunity being buy bonds, is that what you're saying?
Yeah, so what's happened the last few times that we've seen this surge in break-evens, like we're seeing right now, big fear of inflation in an economic recovery, we saw it in 2009, you were at a peak in nominal yields. And I think that's really the challenge that investors are having, is they're fleeing to all of these micro themes, whether it's your Bitcoin or your GameStop, or looking at deep cyclicals for the recovery, when the real variable that's going to drive their portfolios is the macro return. And the macro return profile of the bond market has improved tremendously, and we're probably, within months of the beginning of the next stage of this secular bull market in bonds. In the meantime, people are looking at, is it the real yield? Is it the break-evens? Should be in deep cyclicals. In the meantime, break-evens are telling you you're probably near a cyclical peak in yields.
Can you dig a little bit more into what this means in terms of what you guys are doing with your investments? Have you been buying steadily 10-year treasuries as they sold off and expecting yields to go much lower? Is this meaning that you should rotate into a higher quality credit? How are you rearranging based on this thesis and based on the rise in yields that we've seen of late?
Yeah. Well, I think that the easier trade has been not on the rate side of the bond market equation, but the credit side and the recovery from COVID. And the fact of the matter is that is likely to remain the predominant driver and the easiest source of alpha at this part of the recovery. Usually looking a year, 2 years after this kind of a rise in rates with a strong economy, your credit product, even though spreads have come into tighter than average levels, generally continues to perform well. The trickier part is the rate side. And the market tends to go into this overdrive of extrapolating the rapid growth of the recovery stage into the indefinite future. And that's what we're looking at right now. And the reason why it's difficult to make a call whether it's over, and in my last privilege of being in the bonus round, I suggested your next 20 basis points in rates could be higher and then lower, is because there is this stimulus hitting right now, money dropping into people's checking accounts, checks in the mail, and that sets us up for the potential for another boom in the economic data over the next 30 to 60 days.
Hey, Rob, I wish Tom Keane was with us, because that was a reference to real yield and your appearance on Friday. And if he's watching, I'm so happy that you made that reference. Let's finish on this. Your point about recency bias and extrapolating out the next couple of quarters and how that infects and shapes the long end of the bond curve, 10s and 30s. Do you think that's why front-month crude prices punch above their weight too, just that phenomenon?
Well, I think that's, your typical commodity market phenomena where your short-term supply constraint, it runs first through the front end of the market, and only if that bias is persistent, will you see it go into the back months of the curve. And obviously we're having a short-term dislocation there. I think, on the Treasury curve, I think the one thing that is overpriced are those 5-year tips, but that over the course of the next 12 to 24 months, you're likely to see a good return to risk premium. The biggest problem investors are going to have is sticking with the markets. And you're going to be surprised by the fact that in this environment of the Fed staying on hold, providing a lot of accommodation, the next 12 to 36 months, your macro markets are going to work for you, including the bond market, likely to outperform cash once we get through this last burst of economic activity.
That last burst coming right up, maybe. Robert Tipp, thank you, sir. PGIM Chief Investment Strategist. A few more thoughts from Troy Gajewski. Was just emailing back and forth about this call, Lisa, keeping the conversation going, basically adding to the story that we talked about 40 minutes ago. The end result of Fed balance sheet and money supply growth is asset inflation, currency debasement. Gold was the post-GFC way to play this going into 2010. Bitcoin is the way to play this coming into 2021. Just some more thoughts behind a big call from the team over at Skybridge.
The key idea here is that it is more akin to gold than it is to a currency. Again, though, the question that I have is how much is this contingent on regulatory approval, on a regulatory framework, on the Federal Reserve not to necessarily tokenize the dollar or create some sort of digital dollar that eases frictions in payments, which was one of the big reasons for Bitcoin initially. I'm just trying to figure out what causes the next leg up. And I think that Troy Gajewski wasn't really weighing in on that. He was saying this is the trade for the next 18 months. He wasn't necessarily talking, from what I heard, over the longer term.
Well, it's been the question, I think, for the last 5 years, and I've been asking it, Lisa, because it's the right one to ask. But this particular currency, if we can call it that, commodity Bitcoin, keeps ripping. Is up more than 80% year to date so far. Coming up on this pandemic, as we really start to address things in the United States of America, Deborah Fuller from the University of Washington School of Medicine will be joining us. Really looking forward to hearing what she's got to say on how things are developing in America. In your bond market right now, yields are up 4 basis points on 10s to 167.60. Equity's doing okay, up 0.2%. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. There won't be any quick fixes to that blockage in the Suez Canal. Bloomberg's learned that it will take at least until Wednesday to dislodge the massive container ship that is blocking the waterway. It had been expected to take only a few days. Meanwhile, there's concern the incident will disrupt global supply chains of everything from oil to grain to cars. China is imposing anti-dumping tariffs of up to 218% on Australian wine. The duties will last for 5 years, and they're a sign that China is taking a harder line in its relationship with Australia. Beijing claims the wine has been subsidized and is sold under market value. An industry group and Australia deny that. President Biden said the U.S. is in talks with Mexico and expects to stem the flow of migrants. Thousands of families from Mexico and Central America have traveled to the U.S. border in recent weeks, hoping to be allowed to stay. Families are being expelled under a public health order invoked by the Trump administration, but Mexico is unwilling to accept all of them. The number of coronavirus cases in the U.S. is rising again. That's reversing months of decline and threatening another setback in the return to normality. The 7-day average of new cases rose 9.5% to more than 57,000 on Wednesday. That's the biggest increase in more than 2 months. The number of cases is still well below, though, the peak hit in mid-January. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
am setting a second goal, and that is we will, by my 100th day in office, have administered 200 million shots in people's arms. That's right, 200 million shots in 100 days.
The President of the United States marking to market there. The average right now, 2.5 million a day in America. That's the average over the last 7 days. Phenomenal work. From New York City this morning, good morning. This is Bloomberg Surveillance, and here's your price action. This Friday morning, equities up 8 points on the S&P. We advanced 0.2%. Into the bond market we go, where yields are higher, Lisa, by 4 basis points. 167.24. A real lift. And I've got to say, Lisa, not a big week for economic data. Not a big week for new revisions to forecasts that I've seen. Not a big week for revising the trajectory of coronavirus in America. And yet, we've had a really choppy week for this Treasury market.
Perhaps something had to do with Europe. And I will say that the idea of Germany going into lockdown, the idea of a third wave gaining steam did seem to have a material impact on markets. But I do get your point, and I do agree with it, that there does seem to be this uncertainty that suddenly whipped into markets this week after months of just FOMO, right? Fear of missing out being a primary trade.
Let's talk about this pandemic, Lisa. Deborah Fuller joining us now. University of Washington School of Medicine professor. Professor, it's great to catch up. A real issue right now for policymakers is to try and understand how much of the population they need to vaccinate before they can remove some of these restrictions. What are you learning so far about what we're seeing play out in America at the moment?
Yeah, so as a vaccine, as a virus begins to surge, you would definitely need a surge in vaccination to be able to combat that. So in terms of percentage of individuals that need to be vaccinated, as traditionally, if you look back at vaccination history, when you start to get close to about 50% of a population being vaccinated, you really start to see a dramatic impact in reducing the incidences in that particular region, in particular in disease and death caused by the virus.
Of course, we haven't got all the data yet, but I'm just watching Texas to see how this plays out. We saw that Governor Abbott made the announcement to drop the mask mandate at the beginning of March, Professor, and I think there was a lot of concern about that. But right now, looking at the vaccinations in Texas, our numbers tracking 10 million doses given, enough for almost 18% of the population in that state. And even after they've dropped the mask mandate, which of course doesn't necessarily mean that people stopped wearing masks, what we've seen more recently is encouraging data about cases, and the average cases over the last 7 days or so rolling over again, Professor. Do you think we might be in some of these states already at that point where we can drop some restrictions without seeing anything drastic off the back of it?
Well, the way to really get to that point as quick as possible is to combine both the vaccination as well as the continued mask wearing and social distancing. Certainly, dropping them, the vaccine will eventually do that. It's just going to take longer to get there. So the combination of the two things are really, if we want to get back to normal as quick as possible, to continue a combination of those things together.
Deborah, what do you think that we won't have to wear masks when masks will no longer be commonly seen on streets across the country?
Yeah, I think that it's really going to play out in terms of just watching a decline in the incidences of hospitalization and death and the like. And as we just really have to watch the data. And once it gets to a certain threshold where you're just not really you're seeing a decline in the incidence rather than an increase. As you know, as we go through each day and we watch those numbers, they're still ticking up. But eventually, you're going to start to see those numbers tick down and further, and then at that point is when we can actually start to think about lifting those kinds of restrictions.
What's your biggest concern going forward, Professor, given the fact that we do seem to be on a pretty steady trajectory? There already are states that are opening up vaccinations to everybody over the age of 18, and it seems as though the U.S. is way ahead of its perhaps modest and yet nevertheless ahead of its schedule.
Yeah, the biggest concern eventually is going to come to a point where we're going to have the number of vaccines is going to eventually exceed the demand, and then we're going to be in a situation where we're going to have to reach out to those people who are on the fence about taking the vaccine, because we do need to have as high a percentage of the population as possible receive this vaccine to be able to crush the pandemic.
How helpful do you think it would be, and Lisa's made this point, and I want to build on it, how helpful do you think it would be if the CDC just came out now and gave some stronger guidelines on what you can do if you've been vaccinated? And an additional second part question, if I may, Professor, do you think what's holding them back is they're worried about creating a two-tier society? Is this science, or an ethical question?
Right. In terms of, I guess maybe clarify a bit further what you
Sure, Professor. I'll ask the question and clarify for you. So if you think about the decision you've got to make to tell people who have been vaccinated, if it's scientific, you would sit here, look at the data and say, you can go around and do what you want, if the data backs that up. If it's ethical, you would sit here and say, well, okay, wait a minute, only half the population has been vaccinated. Therefore, if we allow them to go out and do what they want, even if it's backed by science, we have an ethical dilemma because we create a two-tier society. So I guess what I'm asking you is if this decision is backed by science or if it's purely an ethical one.
I think it's a little bit of both. We have to remember that if you have some people vaccinated and some people unvaccinated, that vaccination, while it's completely protecting us from disease and hospitalization and death, it's still possible that people who are vaccinated may still be able to carry the virus and transmit that to unvaccinated people. So it's driven by science in terms of protecting everybody and ensuring that everybody continues the same practices, because we need to, even if you're vaccinated, you still want to be able to protect those who are unvaccinated.
Professor, thank you. Appreciate the answer. Appreciate your time. We really do. Deborah Fuller there of the University of Washington School of Medicine. Lisa, that's the issue right now. And some people in science have got the answer to that question. Others haven't. Many are still thinking about it. And I think it's a difficult one to address.
We keep saying that we're in basically the biggest science experiment of modern era. And that, to me, is, I think, the big takeaway, the idea that policymakers are looking at scientific data that is quickly moving, trying to make the right decisions based on data that is not necessarily completely comprehensive and conclusive. And policymakers all have different approaches and have political bents. So you're dealing with a very difficult scenario to parse through, which leads to all of this patchwork of different policies that leads to a lot of confusion and, frankly, skepticism that might be unfounded, John.
And citizens who want to reclaim their civil liberties and make the decision for themselves, Lisa. That's where we're at now. The frustration, and you've been on top of it too, frustration right now is palpable. People don't want to wait to be told by a politician what they can and can't do. They want to get on with their lives.
It's tricky, though. I will say, I don't know. I don't want to go too hard on this idea of civil liberties, because on one hand, it's protecting people at restaurants. It's protecting people at stores if you say there is a mask mandate, right? I mean, that's sort of one of the key questions with civil liberties is, you know, if you want to wear a mask, go ahead, wear a mask. If you don't want to wear a mask, then don't wear a mask. And yet it's very hard for a store that is saying the customer is always right to say, you know, please put a mask on if there isn't a mask mandate. So it's a very tricky time. I think the bigger question that you've asked earlier is a really important one. Will politicians relinquish some of this power when the pandemic is over?
Will they let go? We'll see. I think Texas is a really interesting case study developing in America right now. From New York City this morning, good morning. Your equity market shifting higher on the S&P, up 0.2%. Yields up 4 basis points to 167.60. Rounding out the week with the euro with a 117 handle. Finally, it broke this week. Story's been obvious for ages, and then we had a move lower. Euro dollar 117.75. This is Bloomberg.
Not only just COVID, but it's COVID related, but it's also stress related to job. I think COVID probably just sort of was the nail in the coffin for a lot of us. the destruction room here is also a very healthy outlet. I do not encourage it as something that we do on a regular basis, but I do find that when people come in, being able to break plates, being able to write out whatever's on their mind and letting it go, being able to just take out their frustration and their anger.
We're thankful to be able to come to a place like this and be able to break some stuff and release some tension without going to jail.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's very much, very optimistic about GDP growth, very optimistic about reopening, the vaccines.
The downside, of course, is higher interest rates, higher inflation, and that's really taken some of the steam and froth out of markets.
There's no doubt that this huge Biden stimulus will stimulate the U.S. economy. The question is, how big will growth be?
The case to consider tax increases, given where our fiscal position is compelling.
If we do start to see inflation rise in the United States, there's a very good chance that could be exported elsewhere as well.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
As my good colleague Tom Keene would say, rip up the script from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Tom Keene out of the building alongside Lisa Abramowitz. I'm Jonathan Farrow. And Lisa, we've got to rip up the script on that Bitcoin call that came from an hour ago from Troy Gayeski of Skybridge, saying that basically the fate of your portfolio, the performance will be dictated to how you are positioned around Bitcoin in the same way your performance in 07 was dictated by how you were positioned around subprime.
And yes, he's talking his book, and his book is
of course
a significant portion Bitcoin right now. But that is fascinating. The idea that they boosted their allocation to the crypto asset in December to 5%. It is now more than 13% or about 13% of total holdings. And they are not adjusting that. They're not necessarily selling, which raises questions about volatility and that risk. And basically he's saying it is a better risk-adjusted volatility bet. It is a better bet on the macro scene than anything else right now, even given the incredible volatility that we've seen.
So, Lisa, we've got to talk about that. He's not rebalancing. Will others? Will others have the same situation, and will others be willing to tolerate that kind of volatility after we've seen a massive move this year already of north of 80%? Trying to clarify that with Troy right now, just going back and forth to get more clarity on this call, the limits that he'd be willing to tolerate. Okay, you're comfortable with 13% of the portfolio. Do you want to take it to 20, 25? How far would you want to take that?
He said some really interesting things, though, that we probably have seen the peak amount of opinion with respect to how much you're debasing the currency, about how much stimulus is being put into the markets. That already has happened. And that's why he said that he built the position in December, because he saw that momentum building. Now he's holding, and he's holding into the future. The question I have is the regulatory landscape. When we talk to institutional investors, they say they will decide whether or not to follow in the footsteps of the likes of Skybridge, depending on the sign-off and the guidance from the SEC. Congress currently debating some regulation right now.
The debate continues ahead of the opening bell. Here's the price action for you. On the S&P 500, we drift higher just a little bit. It's a mild move, up 0.2%. In the bond market, yields with a lift. It's been a choppy move the last couple of days. The 7-year supply soft again. We'll talk about that later. Up 4 basis points, 167.42. In foreign exchange, euro with a 117 handle. Lisa, hasn't it been amazing to talk about euro dollar? 117.76 had that clean break of the 200-day moving average earlier this week. But the story's been pretty obvious for a while now. The news out of Europe, incrementally bad. The news out of America, incrementally good over the last 3 months or so. I think that summarizes things fairly accurately. And yet it took a while to see a clean break in the euro like the one we've seen over the last few days.
Something happened, though, and I think that Angela Merkel's comments about shutting down the nation over the Easter holiday was deeply sobering. And even though she reversed it in a very unusual apology, it still stands out as highlighting the starkness of the reality there, of how far they've fallen behind. And now you've got a European Union summit taking place where basically they're yelling at each other over who's to blame for the bungling of the vaccine rollout. Does not give you confidence that they're gaining steam to move past this quickly.
Let's add to this with Beata Kerr, A.B. Bernstein, co-head of investment strategists. Beata, great to have you with us on the program. I want to start right here. These stories are so obvious. We've been talking about them for 3 months, but for some reason it takes a while to see them play through markets cleanly. Why do you think that is?
The stories on the vaccines and reopening, Jonathan?
On Europe versus the United States specifically. The discussion that Lisa and I were just having. Europe, the news incrementally bad. The news out of the United States incrementally good. And yet euro dollar held in there through much of the last couple of weeks until the last couple of days. Financials in Europe have performed nicely. Travel and leisure stocks have performed nicely. Despite what we've seen, stories we're all aware of. Yet we keep asking, it's well known, is it well priced?
Yeah, I hear you on that, but I think we have to be conscious of the fact that the vaccine alone and the COVID story alone does not tell the whole story. You know, what we think about at Bernstein as global investors is what are the companies that are headquartered in this region and how are those companies affected by their slow rollout of the vaccine? And while the domestic consumer and the domestic implications are negative, many of these companies are actually exporters. Many of them are their cyclicals. And when you see the U.S. in what we would call a great reopening, their opportunity for export is actually high. And so I think you have to look at the whole big picture in terms of the earnings story. And then there's the valuation, right? As fundamental investors, when we think about the stock opportunity abroad compared to the stock opportunity in the U.S., the spreads have been enormous between the valuation of the U.S. and other countries. Obviously, U.S. growth versus U.S. value. There's a real opportunity building for selection, and whether that selection is in asset allocation, in sector selection, or security selection, I think it's bigger than the headlines, Jonathan.
And picking up on something you've just said, I think was in the data this morning, Beata. Lisa, we saw that in the EFO data. Business confidence in Germany, despite what we've seen, has been picking up. The outlook's brighter. Why is the outlook brighter? Because what's happening elsewhere is looking better. It's not just about what you see play out in Europe. It's the international story.
That's right.
It's definitely true, Beata. Carry on.
I was just going to say that's why we're remaining committed to being a global investor. I think it totally depends on your perspective. I heard the conversation on Bitcoin an hour ago and all your follow-up. You know, at Bernstein, we're investing for our clients for decades, not days. And we think about all the trade-offs and the decisions we make. We think it's a mistake to be a U.S.-only investor, right? And the geography, you're going to have trade-offs within the individual countries and their growth potential. And there's no doubt about it, Europe is really behind the U.S. in terms of COVID today. But you have to think more long-term. To your point, global businesses are headquartered there. The great reopening in the U.S. is going to drive outcomes there materially.
All right, so what's the biggest bet right now that you see as being perhaps undervalued in a world that seems, for the most part, completely overvalued?
Well, I'm going to argue that active investing may be the biggest bet that we're making. The idea that you can't just own the index. We know, look at the S&P last year. S&P incredibly concentrated, the top 7 stocks, representing really the highest concentration we've seen in the index ever. We know what those companies are. They're all in tech. They're the work from home beneficiaries. And with this great reopening, work from work is going to start to matter more. And that means cyclicals matter. That means industrials matter. That means small cap matters, and utilities and consumer staples and value. These sectors so underperformed last year, and our theme with our clients was really balance. Let's not get whipsawed trying to pivot from growth to value, value to growth. Let's maintain exposure over time, but let's be active. Let's make sure that security selection and focus on fundamentals is our guiding light, and that remains the case today.
Yeah, well, perhaps this will be the year of active management. People have been saying this for a long time, but people are saying this time really is different based on the index construction. Because we're talking active management and portfolios, let's go back to where we started this hour. John was talking about that interview that we had with Troy Gajewski of Skybridge, where he said that the key aspect of a portfolio, which will be the big winner or not for 2021, is Bitcoin. Are you investing in Bitcoin?
We are not investing in Bitcoin on behalf of our clients. When we think about outcomes for our clients, we think about number one, what is the fundamental case for the asset class? What's the return and risk and diversification story? And importantly, can we research that story with an edge? We think we've got a long way to go in the crypto space in terms of determining the edge and ultimately what the valuation should be. The influence of the individual investor is not going away. But when you look at the influence of the individual investor on Bitcoin today, it's huge. And it's pretty hard to predict that behavior. We feel much more confident investing in asset classes where we can base a fundamental story. So for our clients that are concerned about inflation because they're spending a lot from their portfolio, don't have wages that would be going up if we do hit an inflationary period, we think about a balanced position of inflation-linked bonds and diversified real assets. Those are asset classes that we have decades of experience in driving the fundamental story. Bitcoin, we're simply not there yet.
Pce, great to catch up, of AB Bernstein. Very transparent and honest. And Lisa, I've got to say, I was in the same position, still am really, just trying to understand the asset class just a little bit more. And I've spoken to many people who are very much for the asset class and others who just don't have the risk tolerance for it because, like Beata, they don't understand the day-to-day moves, what's behind them. And I'm in the same position right now. And to find an edge on something like that is tremendously difficult.
And how to define it. And what Skybridge's Troy Gajewski said, that this isn't necessarily, he didn't talk about this being gold that he was going to necessarily use as a form of currency. He was saying this is a bet akin to the short position on subprime. The idea here that this is representative of the larger theme of monetary debasement, of printing money in order to get us out of this hole. That to me is the question. The people going into this now, are they going into it as a trade or are they going into this as true digital gold that has a very long-lasting footprint on the financial system, John?
Well, I think you're asking the right questions, and we have to continue asking questions. It's become very tribal, where you have these diehards on the one side and these diehards on the other. I have to say I've been really humbled by the price action of the last 12 months. Some huge moves, Lisa, against a wall of doubts. And the questions that we ask still right now about the asset class, why it can remain, why it can persist, you try and push back just to try and counter it, play devil's advocate. We've been asking the same questions now for the last several years, and you've seen what's happened. It's just kept going higher.
Well, but exactly what Beata Kerr was talking about, this idea that institutions are still reluctant to go into the asset class because it hasn't gotten the blessing of some sort of official body. It's not being used in some sort of fundamental way to analyze. What tips that balance? And that, I think, is what a lot of institutions are looking for. Others aren't waiting.
A bit more clarity from Troy, just sharing a little bit more clarity on this position. It's grown to 13% of the portfolio. We've been asking, when would you rebalance? What would you tolerate? Would you let it go higher? Hasn't made a call on that yet. Just not planning on trimming the position going into April. Troy Gajewski with a really interesting call on Bitcoin. In your FX market right now, euro dollar 117.77, bonds yields higher, 4 basis points to 167.42. In the equity market, equities up a little more than 0.1%. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. It will take longer than initially feared to free that giant container ship that's blocking the Suez Canal. Bloomberg's learned it will take at least until next Wednesday and maybe longer. At first, it was believed the operation would only take a few days. This concerned the blockage will disrupt global supply chains covering everything from oil to grain to cars. The Fed is signaling an end to pandemic-era restrictions that dragged on financial stocks last year. Big U.S. banks that clear the next round of stress tests with sufficient capital will be allowed to resume dividend increases at the end of June. Limits on stock buybacks also will be lifted. And Citigroup has hired the Chief Diversity Officer of Goldman Sachs to lead efforts to diversify its own workforce. Erica Irish Brown is joining Citi as Chief Diversity, Equity and Inclusion Officer and Global Head of Talent. She'll also oversee succession planning and leadership development. And WeWork has agreed to a blank check company deal that would take the shared office provider public. The merger with BowX Acquisition Corporation would value WeWork at $9 billion, including debt. In 2019, WeWork was valued at $47 billion in a round of financing with SoftBank. The firm later had to rescue WeWork and now holds a majority stake. Shares of GameStop on a roll. The video game retailer is higher pre-market after gaining 53% yesterday. Some of the other so-called meme stocks favored by investors on Reddit also higher today. That's including AMC and Express. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
I'm Eric Schatzker. Join me for my front row conversation with Soros Fund Management CIO, Don Fitzpatrick.
When there is a dislocation, we're prepared, to not just double down, but triple down when the facts and circumstances support that.
Catch the full front row interview with Don Fitzpatrick this weekend on Bloomberg Television.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
case, it was fairly clear to us that if there was going to be a big move, it would be somewhere in the near term, and so we needed to front load that. So we started nibbling in mid-November. We think this year it'll be somewhere between 8 to 12 because of how much the Bitcoin position's grown. But it's a unique opportunity where you're actually getting paid for that risk.
Troy Gajewski of Skybridge with the call of the morning from New York City this morning. Good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keane back on Monday. Lisa, no doubt, on Monday we'll carry on this conversation on a big call from the team over at Skybridge.
In particular, the implications for the macroeconomic backdrop of this year, the idea of how much money can you print before people look for some other new way of putting their money somewhere and parking it.
Bitcoin ripping this year, up more than 80% and up a couple of percentage points this morning. Rest of the price action this Friday looks like this. On the S&P 500, we advanced just a little bit, up a little more than 0.1%. Yields have been climbing over the last couple of hours or so, up 4 basis points on 10s to 167.24. And crude still south of 60 on WTI, but 59.84 is where we trade right now, up a little more than 2 percentage points. You will have heard there is a big ship stuck in a canal, and you don't need a commentary from an idiot like me. We need to talk to someone smart about it. Randy Givens joins us now, Head of Energy Maritime Shipping Equity Research over at Jefferies. Randy, thanks for your time today. Let's just start here. Typically in the media, we'll throw around the word crisis all the time. It's a crisis. Can you help me understand how close we are to what you might call a crisis and how you define one for the shipping industry?
Absolutely, yeah. Thanks for having me. Yeah, you never want to waste a good crisis, right? Especially in the media. So with that, what we're seeing in the Suez Canal is certainly unprecedented, right? When you have a vessel of this size stuck to this degree, it is a crisis when it comes to global shipping, right? The Suez Canal is a major artery. We're talking 10 to 12% of trade goes through that canal. So when you shut that off, there's a crisis will ensue. You have to obviously divert cargoes, reroute cargoes, go around South Africa instead of kind of cutting through the shortcut via the Suez Canal. The big question is going to be the degree of the blockage, the duration as well, right? Does it take 2 days, 5 days, 12 days, 5 weeks, right? And we're hearing so many conflicting reports. The Egyptian government today, just a few hours ago, is saying, oh, it will be fixed this weekend. That's optimistic. Possibly there's an Easter miracle and this kind of will pass over soon, but it could certainly last a few weeks, right? This vessel is massive. We're talking 4 football fields in length. The Empire State Building basically floating in this canal. So it's going to take higher tides. It's going to take extra equipment to dredge out some of the siding that the vessel is run aground against. But we'll see. You know, if it does take a few weeks, there's going to be a tough decision for current captains and ship owners to say, do we wait this out and hope to make it through the canal soon? Or do we just cut our losses and leave and go around, again, South Africa, and then head up to Europe that way? So that takes an extra 10 to 12 days right there. So it truly is a tough decision. And we've seen the tightness in global shipping markets across container ships, dry bulk, even tankers now, with rates jumping 10, 15, 20%. So this is certainly a short-term crisis, at least.
Well, Randy, the word that central bankers would throw around is transitory, and I started the week by talking about that, whether this would just be a transitory issue. Do you see any permanent damage being done the longer this goes on?
Yeah, you know, I, as well, thought it would be maybe 2 to 4 days just because of this being such an important waterway, right? That said, obviously the damage is there. Now, permanent probably is a strong word. They will obviously do some kind of new regulations around maybe speed limits, maybe size of ships that go through this canal, right? They recently expanded it, and that's why this 20,000 TEU vessel, which again holds 20,000 of those containers that you see on the back of an 18-wheeler. So massive ships, right, going through this. So they might enforce a speed limit. So we could see some further regulation. Now, there will probably be some damage to the canal that has to be fixed in the coming weeks. But again, I don't think it'll be a long-term permanent thing. But certainly the month of April could be impacted.
Randy, this came at a terrible time. Already supply lines were being stressed in major ways, and we've seen, and I've been repeating this, I know I sound like a broken record today, but I really am struck by how much the digital era has highlighted some of the fallibilities, some of the vulnerabilities in our fundamental infrastructure, our physical world. How much do you expect that to have very long-lasting effects? The idea here that companies really have to invest more in rearranging how they get goods, where they go, how they go, in order to meet this just-in-time world that we're increasingly becoming.
Yeah, that's a great question. We've seen shipping become kind of taken for granted and an afterthought, right? And when you see these kind of crazy events, when you see sanctions step up, when you see vessels being attacked in the Arabian Gulf, piracy, all these kind of one-off events, you kind of realize that it's a tight balance where you see the supply demand and the flows of the supply chain and of container shipping and dry bulk and tankers and all these commodities, right? Now, there's going to always be a disconnect between producing regions and consuming regions, thus the need for shipping. Now, that said, we're already seeing a little bit of near sourcing on the container ship side. We're seeing inventory levels. They're low now, but the plan is, look, we can't just keep living by a thread, right? We need to increase our inventories, and this is across all commodities. But as you mentioned, the global supply chain is tight, and that's why container rates, for example, are pretty much at all-time highs. Container ship rates very strong.
Yeah.
So come them and Danaos and Global Ship Lease making record earnings. But you've also seen it now on tankers. Tankers have been bad, right? Rates have been bad in recent weeks and months, especially with OPEC limiting production and all of these other reasons, demand's down. That said, rates in the last few days have been going up, right? So Ardmore, Scorpio tankers, you're going to have all been improving.
Well, Randy, I want to finish there, and we just have about 30 seconds left, but the cost to ship a 40-foot container from China to Europe has quadrupled over the past year. How much are those prices going to come down, or are they?
Yep, they'll certainly come down. You won't see at these kind of astronomical levels forever, right? It quadrupled, meaning around $2,000 for one of those 40-foot units to $8,000, right? We do expect it to fade. We don't expect it to go back to 2,000, right? It might go back to 6,000, maybe 5,500. But the supply-demand balance is so. People are spending more and more money on furniture, containerized goods, clothes, appliances, and less on travel, sporting events, concerts. So to keep it short, rates will go down from here, but they're not going back to 2,000.
Randy, good to catch up. Randy Gibbons there, Head of Energy Maritime Shipping Equity Research at Jefferies. Takes a long time to build a ship. That's the big issue, Lisa, to get supply to reach more demand. And also, many of these ship companies, these shipping container companies, have been conditioned by the previous cycle where they got whacked, and we had for a long time oversupply in various parts of the shipping industry as well. So echoes of what you've seen maybe in mining as well elsewhere. But ultimately, what have we seen here, Lisa, in the last year? Demand collapsed, and then we've seen a monster inventory build off the back of all of this in a really short amount of time. It's going to take a long time for those issues to fade. And on a whole series of fronts, the conversations we're having all go back to the same thing. What's transitory? What's permanent? What's going to last a couple of months? What will we work our way out of?
All good questions, and we'll find the answers in the next couple of weeks.
Coming up, a conversation with Patrick Harker, the Philly Fed Reserve President. Looking forward to that. Sitting down with Michael McKee, a conversation you don't want to miss next on Bloomberg Surveillance.
enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
City, for our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz. I'm Jonathan Ferro. I'll get my words out. Here's your equity market, up 4 on the S&P, up a little more than 1/10%. Your bond market yields climbing higher, bleeding higher by 4 basis points to about 167 on a US 10-year maturity. That's your yield right now. Bit of economic data dropping across the Bloomberg. Let's cross over to Michael McKee for a bit more of that. Hey, Mike.
Good morning, John. Well, we're looking at advanced trades goods balance that comes in a little bit worse than forecast at 86.7. The prior was 83.7 billion, and that is going to contribute to a wider first quarter deficit. Here come the income and spending numbers, and that's the ones that we really wanted to see today. Personal income down by 7.1%. Last month it was up by 10%. This is obviously because the stimulus checks came out in the month of January, and they didn't in February. Spending, though, down by 1%. It had been up by 2.4%, and the forecast was for an 0.8 decline, so that's a much worse number than we anticipated. The Pce Deflator, this is the Fed's favorite indicator, comes in softer than anticipated, 0.2%. The forecast was for 3. It was 3 last month, and on a year-over-year basis, that leaves, well, actually, we see the Pce Deflator go up 0.1 to 1.6% from 1.5%, although it doesn't seem to really matter a whole lot at these levels, and this is also February data. It's the March-April data that's really going to matter because those were the months where the price indexes dropped off the map. Well, joining me now to talk more about inflation and the outlook for the economy is Patrick Harker. He is the president of the Federal Reserve Bank of Philadelphia. And good morning to you, Pat. Thanks for joining us today.
Good morning, Mike.
Inflation tame in February, but that's not what the Fed expects going forward. The Philly Fed index that came out this month was the highest for prices paid since 1980. Do you anticipate a really, really rapid rise in prices? Is that what people in your district are telling you?
No, that's not what we're hearing across the board. We are seeing in certain pockets, like manufacturing, their supply, they're seeing price pressures. But what they're not doing is planning on passing much of that along to their consumer, to their end customer. So I think it's the inflation story is complicated. As you said, we're going to see March, April drop off. They were low months, obviously, because we were shutting down the economy. So we're going to see a spike in inflation. But I think our forecast is for inflation to creep up to 2%, and our goal is to have it hit above 2% this year. Our forecast is around 2.1%, but we don't see it running out of control.
What about the idea that on the spending side, people are reluctant to go out? What are you hearing in Philadelphia? We're getting more jabs in arms, and yet we see personal spending decline in the month of February.
It's been choppy, right? Because the virus has been variable. We've had good months, bad months. We're seeing numbers rise now in this region. And so until we get through this period, we're going to see a lot of volatility in all these measures. And that makes them hard to read. So for me as a policymaker, in that kind of situation, I want to hold steady, make sure we get through this period, then we can start to normalize once we get through this.
When you say get through this period, how long do you think it lasts?
Well, again, if you talk to epidemiologists, not economists, they'll say sometime in the fall we should start to get herd immunity. I'm a little concerned, though. Some of the things we're hearing right now is vaccine hesitancy is real. We even hear this from our healthcare contacts, right? Healthcare workers themselves are reluctant to get the vaccine. So we need to make sure we get this vaccine into people's arms as quickly as possible.
What are companies telling you about finding employees? You're focused now on getting unemployment down as low as you can. Some companies seem to be saying they can't find enough people. Yeah. Other companies say we don't need any more people yet.
It varies again by sector. In manufacturing, skilled labor is a real shortage. And we're hearing this from all our contacts. Warehousing jobs. There is a warehouse in central Pennsylvania that the starting salary for people there is $23 an hour. So again, it depends a lot on the sector of the economy. Hotel, hospitality, and leisure, some of those are having problems getting people back to work because those people have decided to switch careers to something that they think is more stable.
I know that a lot of people say the Fed doesn't have tools to boost employment, but you've got a new one at the Philadelphia Fed to help people switch careers.
Yeah, so through our community development function at the Fed and at the Philly Fed, we've been doing work now for a long time on what are the skills necessary to help people get into the middle class, where you don't need a 4-year college degree. We call those jobs opportunity occupations, jobs that pay above median wages where you don't necessarily need a 4-year college degree. So we've been doing that work for a while. We've looked at 33 metro areas along with our colleagues at Cleveland and looked at these areas. We saw an average increase of about $15,000. That is, people with some skills, with some upskilling, could get a better job and improved a lot for themselves and their families. We then now built this tool, and this tool is meant for job seekers, employers, community colleges and other training organizations, policymakers, to see what's available in their region. Let me give you 2 examples of what you can find. So let's say you're a receptionist in Philadelphia. Well, you have skills that you can upskill to a medical secretary and see on average, an increase of 26% in your salary. Or say you're in Cleveland and you're a cashier. Well, with some training, you could be a customer service rep. And there, you could see an average increase in salary of 135%. It's not just white-collar jobs, there are blue-collar jobs. So what's nice about this tool is you can lay out a map of what skills you need to get the jobs that are growing or shrinking. You can also see whether those jobs are growing or shrinking in your region.
Now, I know if I ask you about market interest rates, you'll say markets do what markets do. They go up or down. But here's what I'm interested in is rates have gone up. Mortgage rates have gone up. Car loans have gone up because the market is pushing rates higher, not the Fed. Right. Are people more sensitive to that when they have been so low? In other words, is it more of a risk that we see activity slow because the markets have pushed up rates some?
Well, let's start with business investment. I've not heard anybody say they're not investing because of rates. Just don't hear it, right? It's because the demand side or the uncertainty that they're facing. So we need to resolve this uncertainty so that people can make the right decisions. I'm not the consumer, maybe, but again, we're not talking about massive increases historically in rates. I mean, if you really step back, we're talking about what, 100 basis points, maybe. This is historically not really something that's really affected people's decision to buy a car, maybe on the margin buy a home or the size of the home they get. But again, this is a good sign in some ways that rates, say the 10-year is going up. We don't know exactly why, but one of the plausible reasons why is that real rates are going up. People are more optimistic about the economy. And we've been hovering at 0 or negative neutral real rates for a while. So the fact that that's rising is a good sign because it shows optimism.
A question I put to the chairman after the news conference that I didn't quite get an answer to, I'll put to you. You mentioned real rates and you mentioned the long term. When do we get to that 2.5% neutral rate that is considered the long-term rate for the Fed? In other words, if you get to 2023 through 2023 and we don't see inflation out of control, do we just leave rates at 0 indefinitely?
Yeah, we'll have to see when we get there. I'm not sure that would be my, and I can only speak for myself, my policy prescription. I mean, if we're seeing very strong unemployment, back to where we were before the pandemic, right? Low inflation, great unemployment numbers. That's where we want to get back to. And so there are some risks of keeping rates too low too long as well. And it's really a matter of balancing off these risks. But it's very situational. I mean, you can't just make this decision right now. You really need to see the data and see how things are unfolding.
Well, you talk about the risks of keeping rates too low for too long. A lot of people point to the stock market or Bitcoin and say, you know, the Fed is really inflating bubbles here. How much of a concern is that to you?
It's something that I keep in mind all the time, that and the cost to savers. People will say on fixed income, there's a cost. So again, this is a balancing act. We need to get the economy to recover. We need to get the economy to heal with minimal scarring. That's what was the whole goal of what we did at the Fed for the past year, is trying to preserve as much as we can of the infrastructure of the economy. So, you know, I think once we get through this, we can start to then think about how we normalize.
Well, we get to maybe 2.1% inflation as you forecast, or a little bit higher as some of your colleagues forecast. The market's going to start pushing up rates. And the question is this a showdown between the markets and the Fed? And will the Fed blink? You've got a new framework to work in that you never have before, and the markets are going to want to test it, I'm sure. Can you look through rate increases, or is there a level at which you get concerned?
I mean, there's obviously a level at which you get concerned, to be some exorbitant level. But if they're within the realm of reason, I am of the camp where we stick with our framework and we let inflation run above 2% for a while, not running out of control past 2%, but above 2% for a while. That is what we've committed to with our framework, and I am committed to that as well.
Well, everybody's going to be looking to wage inflation to tell the story of whether or not we're seeing inflation rise too quickly. In the last beige book, the Philadelphia sector said that wages are rising because of demand for labor. The $15 minimum wage, they quoted one Philadelphia CEO as saying, is already here. Are you seeing a rise in wage pressures yet?
Yeah, again, if you look at that warehouse in central Pennsylvania paying $23 an hour, they're getting their workers from somewhere. And those firms, in turn, respond by trying to raise wages to retain or attract new workers. So, yeah, we're starting to see that. But again, it's not across the board. It's in certain sectors right now.
Not a wage price spiral.
I don't see it right now. I mean, it could happen, but we're not seeing it running out of control now.
Patrick Harker, thank you very much for joining us this morning. He's the president of the Philadelphia Fed, and reasonably optimistic outlook there, folks.
Mike, you see that in the commentary around long-term rates, reflecting the optimism, sticking to script. And I think what you've got to do, and I know you're going to do a great job of it over the next couple of months, is when we start to see the data, see who is committed to the new framework of the Fed and maybe who isn't, who starts to be swayed by the data they're seeing. And certainly at the moment, Mr. Harker, the president of the Philly Fed, seemingly committed to that new framework, Mike.
Well, he did say that there is a level at which he'd be concerned. It'll be interesting to see how fast market rates adjust once we get the numbers from March in terms of the inflation data, because March and April, the two worst months, and so we just mathematically we're going to get a big rise. And if commodity prices keep going up, there's going to be some tough headline numbers. So do they blink? That's going to be a real test for the Fed.
Just to take the opportunity to tease the next show with Mohammed Al-Arian of Bloomberg Opinion. And Lisa, the reason I bring this up is not just to wind Tom up, who I know is watching, and taking the opportunity to drag it out and draw it out a little bit longer ahead of 9 o'clock Eastern time on Bloomberg TV. Actually, it's an important conversation about whether they would have adjusted this framework at the Federal Reserve if they had known what was about to happen with fiscal policy, what was about to happen with a monster vaccination rollout as well. Would we have seen this framework adjusted to the degree that it was at the end of last summer if they knew what would happen at the start of 21?
Well, fiscal policy is still happening, right? Because, Neri, the infrastructure spending, how much does that shift their opinion, if at all? And that, to me, I think, is one of the key questions going forward, John.
Just before we go, Mike, your view on that. And I know it's a difficult one to answer, the counterfactual, but what do you think of that? Do you think this framework would have shifted that much if they'd known what the fiscal impulse would be in 2021?
I don't think they would have changed it significantly, because the idea is not so much how fast you get there, but how you get there. And that's what they're going to be looking at.
Mohammed Al-Arian coming up a little bit later on Bloomberg TV. Lisa Abramowitz will drive you into the 9 o'clock hour. And Bloomberg Radio will take you into the opening bell as well. On Bloomberg TV, we'll catch up with Mohammed and we'll talk about this bond market too. Yields are higher by 2-3 basis points on 10s to 166. Your equity market up 1/3%. What a week. We're almost there to the weekend. Heard on Bloomberg Radio, seen on Bloomberg TV.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Now is the time to clear the backlog and repair our highways, roads, bridges, maritime ports, airports, and more to enhance freight and passenger rail and to provide accessible public transit and mobility options for all. I stand ready to work with members of Congress on both sides of the aisle to deliver an infrastructure package that meets this consequential moment and ensures a future worthy of our great nation.
Transportation Secretary Pete Buttigieg speaking on the importance of an infrastructure plan. That was the message very clearly from Joe Biden at his first press conference as the President of the United States. This next conversation, I love this. We've been having a series of candidates for New York City mayor come on this show and talk about what they will do. Yes, this is important for the city of New York, but frankly, it comes at a pivotal time for big cities across the world. We have a situation where the pandemic has uniquely challenged them existentially, and and economically in the years ahead. Joining us now, Maya Wiley. She is a Democratic candidate for New York City mayor, and she has been a longstanding member, both legally as well as a member of the media as an MSNBC commentator. Maya, I want to start with your experience working as a counsel to Mayor de Blasio, and I'm wondering, heading into this election, is that a benefit or a detractor? How do you plan to use how he has handled the pandemic in order to inform your campaign?
Well, thank you for having me, and it's a pleasure to be with you. And let me just start by saying, you know, I stand on my own 2 feet. This woman has done that as an activist, an advocate, a civil rights lawyer for 25 years before I went into City Hall in 2014. And I was grateful for the opportunity to serve because I've been a public servant my whole life. But here's the thing, it's the first Black woman to be a counsel to a New York City mayor. I was both proud, but I was also excited. I was excited about the fact that we could do some transformative things for this city. And I was very proud that I got, for example, to be able to get free broadband to every single resident in Queensbridge houses, the largest public housing development in North America. And that mattered so much, as we've seen now at a time of COVID when too many of our children did not have internet access. We knew that before COVID. And having been able to show government how it could do something it has never done before, do it by getting agencies to partner and do it focusing on the folks who need it. That's what I had the opportunity to do. And that's what I'm going to do as mayor of New York City.
And the pandemic certainly has shown a spotlight on the disparities within both income brackets in New York City as well as among the nation as well as around the world. There's a huge issue, though, now of paying for it. And how do you tax people? How do you spend the money required for all of these assets, these important necessities, you could say, at a time when if you hike taxes too much, wealthier individuals are just going to move?
You know, this is such an important question, and I start from a vantage point of the fact that we need a different kind of leadership in a historic crisis. And I'm the kind of leader, because this is what racial justice work requires, what change work requires. It says all hands on deck. You know, what we have to do is partner and work together as a city and with our partners in Albany, in Washington, to say everyone has to put on the table what we have to give. And there's so much when we have this conversation that folks will. But let me just be very clear. I have put forth a platform about stimulating the New York City economy because having worked in City Hall, I know how city government works and I know where the resources are. And we actually can create 100,000 new jobs, and I will create those jobs by spending $10 billion in capital construction. That's a part of the budget I will control as mayor, to build things we need built and to fix things we need fixed. Building affordable housing, money for night job, but that's important to recognize. Please.
Maya, when you're talking about how people should come to the table and give what they can give, are you saying that you do want to raise taxes for the people who can afford to pay them?
Yeah, I do. I've been very public about this in my positions. But here's the thing, and it's the thing we miss. It's how much we agree upon in this city. You know, we have been so deeply divided, or feel deeply divided. And I talk to everyone, and I want to remind folks that during COVID, we actually added jobs in the tech sector. During COVID, we actually had folks move into the city. And so we have growth sectors in this city. It's life sciences, it's tech, it's healthcare, it's many other things. But when we focus on our assets and ask people to invest, the thing I hear back from those who are wealthy is like, look, Maya, I'm happy. I love this city. I never lived in it because it was cheap. It never was. It's always been one of the most expensive cities with higher taxes. But will I have quality of life? Will the schools get better? Will public transit get better? Will we solve street homelessness? And I have a plan to do that. And when they hear that, we have a lot more people saying, if I have a voice, if I'm heard, if it's going to help bring the city back, I'm in. I just need to be asked to the table.
Although there is a question, Maya, about the pandemic and how this has shifted the equation. And we have seen outmigration from New York City, particularly people who can afford it, simply because they may not have to go into the office anyway. There is their belief that you can work remotely. So it doesn't matter if you go somewhere that's cheaper, both in terms of taxes as well as cost of living. What do you say to people who argue that this will be a different time of mobility because of the remote working era?
Yeah, I would say, we're in a paradigm shift moment. There's no question about it. And that paradigm shift was coming, by the way, because technology was already bringing it. What COVID did is fast track it, right? So what that means, when we are in a paradigm shift moment, it means nobody has the answers. And I know this talking to corporate leaders, they don't know. What they have seen and what I do hear is, look, we also saw a decline in productivity. We know we need some physical connection. We know it can't be 100% virtual. We're trying to figure it out. So part of why we need a different kind of leadership, a kind of leadership that I will bring as mayor, is because we need a leadership that listens and partners, because that's how you figure out how to do transformative things when you've never done them before. That's how I got more people broadband access. City had never done that before. This is how we have to lead into this moment. And that does mean being very creative, being partnered, and actually calling folks to the table, because the other opportunity we have in this is actually to reshape our space. Right. And that's why I will create an office to manage open space as well, because we have to rethink things.
Maya Wiley, thank you so much for being with us. We really appreciate your time. Maya Wiley is a candidate for New York City mayor in our series as we take a look at the leadership of the nation's biggest city at a time of transformation for cities across the world. Right now in markets, you're seeing the NASDAQ trailing all others down about 0.3, right down about 30 points. We see the S&P up almost 10 points. Meanwhile, you see yields actually coming off their earlier highs, but still very mildly up, 1.66%. Coming up at noon today, this is a joy. PGIM CEO David Hunt will be joining Bloomberg Television to talk about reallocating in a new world. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's get this week wrapped up. From New York City for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now with equity futures up 0.2%. We begin with the big issue, the president doubling his vaccine target.
That vaccine rollout is probably going to be the game changer.
Under-promising and then over-delivering.
Doubling down on his vaccine effort in the US.
That's been a big success.
We talk about US exceptionalism.
Everything we're seeing now makes sense if you believe, US exceptionalism.
US exceptionalism in terms of better vaccinations.
He will hit the 200 million doses.
A vaccine rollout that started somewhat botched
seems to be going extraordinarily well.
Which has accelerated dramatically. In the US, they are leading the way.
The US is leading the way. We'll catch up with Kevin Cirilli in just a moment. Europe is lagging badly. Let's head to Brussels now and catch up with Maria Tadeo for the latest. Morning, Maria.
Yeah, well, it's a European summit that wrapped yesterday night, and we have an export ban in place. As you mentioned there, the Europeans are trying to catch up with what has been a very difficult vaccination rollout, but it's important to say that they stopped from triggering what would have been a full-blown vaccine war. As I said, they do have this export control system. They could block pharma companies from exporting vaccines outside of the EU, but Angela Merkel was very clear yesterday. We don't want to use this on a daily basis, and we don't want to make this daily practice, but we need a way to defend ourselves. Now, the good news is that we're expecting the European regulator to approve 2 sites, one in the Netherlands, the other one in Germany, to prop up production. The Europeans still say that if they can get to that stage, if they can get to more vaccines, they can get to herd immunity by the end of the summer. So the target is unchanged. They'll still tell you we've had issues, but we are going to get there.
We're going to get there, hopefully, and hopefully quick. Maria Tadeo out of Brussels. Maria, thank you. The one man that I let show up late for this show is Kevin Cirilli, for one reason, because Washington, D.C. shows up late too, which means he's on the phone trying to cram everything into about 20 minutes. Good morning, Kevin.
Yes, absolutely. And look, I think the fallout from yesterday's press conference is still reverberating throughout Washington, D.C. And let's be clear here that yesterday our colleague Justin Sink asking a question about the dynamic of U.S. and China relations. And really it was at the forefront, I think, of all of the conversations that were had geopolitically that we just heard Maria allude to. What's next for President Biden is going to be whether or not he's going to be able to continue with his vaccination goal, but as well as push for infrastructure. But those 3 items are still very much unknown at this particular point.
Kevin, the tone of yesterday's news conference, the lessons learned, did we learn anything about substance from this administration?
No, I think that from my top 2 takeaways are that the president is moving towards filibuster reform. That could have wide-ranging policy implications on a host of other issues. And secondly, that he announced that he's maybe running for a second term. It's going to be interesting to see what negotiating power and political capital that gives to the left flank of his party.
Kevin, good to see you. Don't be late again. Come on. We don't do it to you. Kevin Cirilli, host of Sound On, a little bit later on Bloomberg Radio, 5 p.m. Eastern, I'm told. Kevin, thank you. Let's turn now to Mohammed Al-Arian of Bloomberg Opinion and Queen's College president. He joins us, and he's always on time. Mohammed, it's good to catch up, sir. Let's talk about this. We've got an administration now pushing for 200 million vaccine doses in 100 days. They're well on course. You can see that in the daily average. Everybody's talking about the prospect of overheating. You and I have talked about this offline. Let's do it online. How will you know if we are overheating, and when would you know?
Okay, so first, it's a really good thing that we are making such great progress on vaccination. That in itself opens up the return of private consumption, private demand, which on top of what's happening on the budget side, which on top of what's happening at the Federal Reserve, is giving rise to these concerns about overheating. So there's nothing mysterious about why we're having so much chatter, not just among economists, that started earlier, but within Congress now. How are we going to see it? You're going to see it first in numbers like what we didn't see today, but we will see higher spending. You will see it in retail sales. Then you're going to see inflation go well north of 2%. It will get near to 3% on base effects as well. And then the big question will be, is it truly transitory, which is the word we're going to hear over and over again from the Fed, or is it changing inflation expectations? So look first for spending, then the inflation number, then the expectation numbers.
Well, let's put a timeline on it, Mohammed. How do we stress test the transitory crew? Does that come in June, July, later on in the summer? Is that the stress test for them where they turn around and say, hold on, I thought these numbers would roll over. They're not. This is persisting.
And that's the problem with the new approach. That's what happened when you go to preemptive, which is what the Fed has been. Because remember, monetary policy acts with a lag. And that lag is not easy to predict. So that's when you go from being preemptive, which is what the Fed has been for a very long time, to being exposed to reacting to data, not looking at forecasts, but reacting to data, you risk being way too late and having to slam the brakes. So that is, your question is really important, John, and it shows you the dilemma that the Fed will find itself in. And I don't think the Fed ever anticipated that we would have so much demand in the system.
That's the point we need to build on, Mohammed. And it's a question you posed, and I teased it a little bit earlier on TV and radio. Do you think if the Fed knew what it did now, they would have made the changes they did last summer to that framework?
I do not. I think the Fed was in a secular stagnation mindset. It was worried about getting stuck there for too long, and that governed a big deal of the change in the framework. I think that had they seen, and no one could have, John, no one could have seen, but had they seen that we would have this coincidence of massive public and private demand, I doubt they would have done what they've done.
So let's talk about consequences. You talked about that shift from ex ante to ex post, forecast-based to outcome-based. It's almost a commitment to being late now. And I wonder what that commitment to being late actually means for the length and the shape of this cycle, Mohammed. What do you think it means?
So first and foremost, they're doing it because they truly believe that they have to run the economy extra hard to bring in people who have dropped out of the labor force. And that is important if you care about income inequality, which they do and I do. But in the process, they risk worsening wealth inequality, they risk worsening resource misallocation, and they risk having to really hit the brakes hard. So that is the trade-off that they're navigating through, and it's a very, very delicate balance that they're going to have to find.
So let's take this framework and take the economic framework that you've just laid out, the monetary policy framework, the policy framework more broadly, and apply it to markets. Mohammed, if that's what you're looking at right now from a policy perspective, what does that mean for capital allocation decisions you would be making?
So it simply means we've lost a unifying theme. And just look at what's been happening this week. It's been price action in search of a narrative. And we've had them all, John. It's about oil. It's about yields. It's about the dollar. It's about the retail bid. We've gone through all sorts of narratives to try to explain this week's price action. Why? Because we've lost a unifying narrative of liquidity. That's what it means. So if an investor now has to shift from riding a liquidity wave, which is a very macro call, passive call, to being incredibly selective in what they do. That is what's needed right now. You can no longer just bet on liquidity, which has been a wonderful ride.
More selective within asset classes, within sectors in equities, Mohammed, or more selective regionally speaking? How so?
all of the above. Build it from a bottom-up perspective. Build it on the basis of criteria, okay? Criteria that have to do with balance sheet, that have to do to where are you in terms of secular business, have to do with management team. This is really going to become a granular bottom-up building, and then importantly, take advantage of overshoots. We're going to have a lot more volatility. Indeed, we've already had a lot more volatility, and that's going to continue.
So what should I say back to the happy talk about the synchronized global growth? When that comes up on a show like this, Mohammed, how would you push back?
You say it's about dispersion. Look what's happening between the US and Europe. Look what's happening within the developing world. The theme this year is higher growth, but much more differentiation, both between countries and within countries. That is the theme. So don't get just obsessed with the fact that growth is going up. Yes, global growth is going up, and we may well hit 5% with over 7% for the US. However, we are going to see an incredible amount of dispersion when you go below the aggregate number.
So take away the aggregate number, look for dispersion. Mohammed, that raises an important question for capital allocation then. If growth differentials are the story, what's the best way to play it? Through foreign exchange or through something else?
So it's basically through betting on focusing less on the liquidity factor, which has been really high up, and making sure that your credit-based decisions are well anchored, because you are going to go through rougher water wherever you invest. There's going to be contagion on the way up, contagion on the way down. We're going to have overshoots. I can't stress enough, we're going to have overshoots. And those are going to be really good investment positioning opportunities.
When you say overshoots, Mohammed, are you looking for some kind of inflation-induced volatility through the next several months? Because a question I've been thinking about increasingly is, okay, we all assume the same thing. Data's going to rip through the next several months, exacerbated, fueled by the base effects. I'm trying to understand how people react to it in the next several months when they actually see the data themselves, and how you should respond to it too.
So it matters where we've come from, and the answer is yes. That is a really critical issue. We've come from a year in which you've made money, whether you've been in stocks, bonds, okay, you've made money. Why? Because it was one issue, liquidity. That is less strong. So now it is a completely different mindset to go through. And what we're going to find is we have to deal with some of the excesses of the past. We can't just assume that they don't matter, because they are reflected in people's portfolios. So when we see major changes, you're going to have certain positions that have had too much liquidity to them. And we've seen it. Look at the underperformance of the NASDAQ so far this year.
Mohammed, really smart. Top down, bottom up. A lot to think about. Mohammed Al-Arian there of Bloomberg Opinion, and of course the president of Queen's College, Cambridge. Mohammed, always appreciate your time, sir. Let's turn back to this price action. With your movers at the market desk, it's Taylor Riggs.
Going to start with the financials, John. Yesterday, 4:30 p.m., the Fed coming out and saying that starting June 30, the banks can resume some of those dividends. You have analysts over at Cowen, for example, saying this is a significant change. Big banks will start increasing not only their buyback programs, but start boosting those dividends. Let's flip up the board. Patent warning there, John. And oil, of course, those stocks rising. As that canal, it's still going to be blocked for about a week. 30 oil tankers are among those ships that are waiting. Tesla had a rare violation of a labor law. We'll see how that shakes out in the stock later today. And then, of course, MSG Entertainment buying back MSG Networks. They're saying it is a 4% premium to the closing price on March 10, John.
Drinks on Taylor. I'm about $20 up. Taylor Riggs, thank you. Much more from Taylor going through the opening bell. Coming up, FOMC officials sticking a script throughout a busy week of Fed speak. That conversation up next with Barry Knapp of Ironside's Macroeconomics. 20 minutes away from the opening bell. Equity futures, just a mild drift higher through much of this morning on the S&P 500. Right now up 13. We advance a third of 1%. This is Bloomberg.
trading revenues coming in better than expected, everything. Cash, $1.4 trillion of cash, one of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think it's the inflation story is complicated. Our forecast is for inflation to creep up to 2%, and our goal is to have it hit above 2% this year. Our forecast is around 2.1%, but we don't see it running out of control.
How many times have we heard that? Sticking to script, Philly Fed President Patrick Harker saying he's comfortable with the slight miss in today's inflation data. His comments in line with those of Fed Vice Chair Rich Clarida.
Over the next few months, 12-month measures of inflation are expected to move temporarily above our 2% longer-run goal. I expect most of this increase in inflation to be transitory and for inflation to return to or perhaps just above our 2% longer-run goal.
Expect to hear that word a lot, transitory. Michael McKee joins us now for more. Morning, Mike.
Morning, John. And that means the inflation numbers we get each month on the CPI, PPI, and PCE are all going to be among the most important data points of the month. We got some of that today. The PCE numbers come out a little bit higher, but not a whole lot. The annual rate of inflation under the Fed's favorite indicator, 1.6%. We saw personal income down 7.1% because the stimulus checks didn't come again in February, and spending was down 1%. But it's the inflation numbers Wall Street's keeping an eye on, and here's why Harker's view is important. You take a look at what the Philadelphia Fed Prices Paid Index did this month. It hit a new high back to 1980. And so if he thinks that companies are not going to pass that along, that's going to be an interesting thing to watch going forward. Now, the other question is, do markets really fear inflation? Are we going to see markets react? Harker didn't think so. And here, take a look at this. Here's a reason why maybe he's right. That white line there is where we are with break-evens right now for 5 years. So 5 years ahead, that's where the markets think inflation's going to be. The blue line is where they think inflation's going to be in 10 years. So no, they're not saying it's going to get out of control. And the yellow line is the 5-year forward. So 5 years from now, the 5-year forward is looking at inflation even lower. Right now, despite hand-wringing on Wall Street, people who are trading are saying the Fed may be able to pull this off. The question is, how fast does the economy rebound and push things up? And I'm going to leave you with an interesting note here, John. The New York Fed's weekly economic indicator is supposed to tell us something about the direction of GDP. Look all the way over on the right-hand side. It's the first time that it has been positive since the pandemic began. So we're looking at some growth in the first quarter, and the question is how much in the second quarter, the New York Fed reflecting the idea that things are definitely getting better.
The direction pretty clear, north and almost vertical. Mike, thank you. Mike, thank you very much. We mentioned that Bank of America data from yesterday, retail, card data, spending, all of it put together, total card spending up 45% on the year for the 7 days ending March 20th, up 23% for the 2 years for the last 7 days ending March 20th. Just unbelievable numbers that we could see this month, next, and maybe beyond too. Barry Knapp joining us now of Ironsides. Barry, always great to catch up with you, buddy. Sometimes we make it sound so easy, and often it's not. And Barry, we keep simplifying things by saying, here's rates, here's everything else. Just sort of kind of orbits the sun. It's not that simple, is it?
No, not at all. You know, as I listen to the discussion about inflation, the thing that comes to mind, there's this talk, well, it's going to be transitory, and obviously comparisons will create a surge in the measures over the next couple of months. But listen, if we step back and we think about the last 3 decades and where all the disinflationary pressure came from, it wasn't through services and technology innovation adoption. It wasn't from oil prices. It was from core goods prices. And the answer there is really simple. We went from 750 million industrialized workers in 1990 to 2 billion by 2010. That's the integration of China and the Soviet bloc into the global supply chains. That force, that downward pressure, culminated in 2004, shortly after China was admitted into the WTO. But that pressure is easing, and it seems highly likely that we will go through what was already beginning to be a deglobalization process, right? If you look at Asian exports from the major countries, in the 2000s, it grew at 15%. In the 2010s, it grew at 5%. It's likely to be even more tepid. Think about Intel moving fabs here and the whole restructuring of supply chain argument. It is highly unlikely we will get that disinflationary impulse. So for me, looking at core PCED or CPI is not the inflation measure you should be focused on. It's the import price series, and that one is marching higher. And that's where we're going to get that longer-term inflationary reversal. It just seems inevitable, secular, demographic, and that's really the big longer-term question about the inflation.
So, Barry, let's make it interesting. Let's not talk about owning tips. Let's talk about real ideas. What's the big call option on the story that you're talking about right now?
Oh, it is the reflationary sectors in the equity market. And if you think about, for me, that reflation trend is likely to persist through the cycle. I've drawn analogs to the 1960s. I think they're very compelling. But we're having a recovery in global trade and manufacturing, not just from the pandemic, but also from the trade war. And we're likely to have a recovery in capital spending that's turns out to be somewhat secular as well, for similar reasons around the global supply chain. So then if you think about sectors that really benefit from that, the materials sector, the industrial sector. I'm very partial to Jeff Curry's argument about we've been investing in the new economy for 10 years, not the old economy. Those sectors could just have long periods of outperformance. And the tech period of outperformance for us, it's going to be very similar to the 2000s, where we had a big investment boom in the 90s. Yep. Tech underperformed in the 2000s, or was at best a market performer. And it's similar this cycle. We really invested in the cloud and digitization. Those benefits are going to start to accrue to industrial companies, the building out of the Internet of Things, perhaps even the financial sector, the healthcare sector. That's, for me, how you really want to position yourself for this, not just reflation, but inflation to come.
To be clear here, though, Barry, this is US-centric, this story you describe?
Oh, yeah. You know, as I also listened to your program over the last hour or so, you know, you've talked a lot about Europe versus U.S., and we will have that surge in global trade and global manufacturing. That's going to put upward pressure on the currencies of what I call the mercantilists. So China, Germany, Japan, Korea, they're going to have a real decision. How are they going to deal with this broader deglobalization trend? How are they going to restructure their economies away from being so export dependent in a period where globalization isn't expanding? And it's going to be a mighty struggle for those countries. So even though they'll have a surge in exports, I think their markets will struggle. And so it's very much a U.S. story, though there's, you know, other places in the world. The U.K. could wind up being a beneficiary of this as well. Yeah. If we do have shrinking of those current account deficits.
Barry, really interesting perspective. Bonus round, you're going to stick with us. We're going to do another conversation with you in just a moment. Stay close. Coming up, the analyst action you need to know. That'll be next in our morning calls. Then later, the financials. Barry touching on that. Gaining ahead of the open as the Fed is preparing to lift pandemic restrictions. We're rallying there in your equity market. It's a mild lift on the S&P 500. Up next, Ironside's Barry Knapp and Nuveen's Sarah Malik. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Bit of Q&A with the President of the United States yesterday. Some soft questions. Not much of the answers we might have looked for. Not much substance. Need a lot more. Kept it a mile wide, an inch deep. Maybe that's how the administration likes it right now. We'll stay on top of that. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Jefferies upgrading Altria to a buy, a $58 price target. The analyst expecting the company to outperform as it continues growing its offerings of non-cigarette alternatives. That stock up by 1.3%. Your second call from Wells Fargo, downgrading Viacom CBS to underweight. The media company's 11th downgrade of the year already. The analyst becoming the latest voice to warn about the stock's valuation following its 150% rally. We're down 0.2% there. Your final call, here's one. Baird upgrading Nike to an outperform, turning bullish for the first time in 2 years. The analyst seeing a compelling entry point with investors likely overreacting to China and supply chain concerns. We're up a little more than 2% there. Coming up, the Fed preparing to lift pandemic-era restrictions on the big U.S. banks. That conversation up next with Nuveen Sarah Malik and Barry Knapp of Ironsides. As we count you down to the opening bout to round out what feels like a week that's gone on forever, this is Bloomberg.
Says we should practice before we go to Mars, but some people say we need to practice on the moon. Well, you could practice on the moon, but you can do it at 1/10,000th the cost in the desert in Utah.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bout this Friday morning in New York City. Good morning to you all. Here's the state of play in the equity market. On the S&P 500, firmer by around about 1/3 of 1%, up by 13 points. Down on the NASDAQ slightly. You might say because of this. Barry Knapp might get upset with me if I say because of this. There's your opening bell. Switch up the board because of this. In the bond market, I'll do it anyway. Yields are up by 2-3 basis points on 10s to 166. In the FX market, a 117 handle on euro dollar. I've found this currency pair to be fascinating. We've talked about this story now for the best part of 2 months, 3 months. Incremental good news out of America, incremental bad news out of Europe piling up, and that currency pair wouldn't break until we took out that 200-day moving average, and then it really dropped lower to a 117.85. Into the commodity market, crude with a lift. Look out for energy at the open, up 3.7%. We reclaim a 60 handle on WTI to $60 and about 75 cents. So that's the cross-asset story at the market desk. Working through your movers, it's Kriti Gupta.
Well, good morning, John. You just hit it. You really are seeing oil prices higher. That's part of that read-through from the Suez Canal blockage. The ship's still stuck, and that's showing up in not just oil prices, but in oil equities as well. Analysts saying it's the refined oil products that may be more affected. So names like Valero, Exxon, Schlumberger, always a tough word to say, gaining a little bit more than the others. This is also affecting the shipping industry, of course. Star Bulk carriers will use as a proxy to show the shipping rates are indeed higher. I want to take a look at some of those other names as well, though. Tesla, under pressure, facing more labor troubles after Elon Musk discourages unions. And get this, a tweet, big surprise. L Brands boosting the earnings outlook for a second time in a month on stimulus check spending. Shares up on that. GameStop extending their 53% gain yesterday. Looks like just on a tear once again. And lastly, Boex in the green, becoming a SPAC partner for the $9 billion WeWork IPO.
6%. Financials up by 1%. Sitting on the financials, moving higher after the Fed announced plans to lift restrictions on dividend increases. The Fed's Randall Quarles writing the following: the banking system continues to be a source of strength. Returning to our normal framework after this year's stress test will preserve that strength. On this story, Taylor Riggs. Hey, Taylor.
The source of strength finally showing up within the equity markets in 2021 after a rough 2020. I mean, finally now the second best performer on the inflationary, reflationary, higher yields, steepness of the yield curve that returns. That is that's the wrong chart, but we'll get the right one, John. That is the play that's underway as banks are up 22% so far in 2020.
You don't want to talk about the vaccine drive, just quickly.
Not my
Taylor, you can make the
forte.
pivot. You know you can. Just read the numbers on the screen. Let's get the numbers back up for Taylor Riggs, and we'll go through the vaccine drive.
22% in the banks, John. We will not ad-lib on this program.
No, we can't do that.
Should we just talk about Spain?
Look how bad the vaccine drive is in Europe.
Rate. What is going on with your Europe, John?
Just
Why
not good
can't
enough.
You guys
not good enough.
Get it together.
Let's sit on that for a moment. Taylor, thank you. Just look at this. This is a story in Europe right now, and we're talking about 20% in the United States when it comes to the percent of this population that may have been vaccinated. Given the vaccinations that we've been tracking in America, 2.5 million a day, just phenomenal numbers. And that's the divide right now between Europe and the United States. Taylor, thanks again. Appreciate it. Let's bring in the team. Nuveen Sarah Malik, Barry Knapp of Iresides joins us now as well. Sarah, I'll run through the price action just briefly. Energy on top, financials doing okay. And Barry Knapp hates this because I'll say rates are up, tech's down, banks are up. It's the rate story. Sarah, is it that simple?
Actually, we think that there's actually a chance that the reopening actually hits an air pocket at this point, because really what we're seeing is rising cases, not only outside of the U.S. in areas like Europe, India, and Brazil, but even in the U.S. New cases for COVID are as high as they were in mid-February, and we think this puts that synchronous global recovery at risk. It has implications for the dollar, which could strengthen from here, which is more positive for the U.S. So for us, it's less about rates, more about the cyclicals versus growth battle. The Fed came out last week and they were dovish and said they won't raise interest rates anytime soon. That's another point for growth stocks going forward. And so going forward, we're looking at those sectors actually that, because of this volatility that we expect around growth and value, look for those sectors that have their own tailwinds. So sectors with tight capacity, such as semiconductors. Semiconductors are becoming ubiquitous. They're showing up in phones, computers, automobiles, everything that consumers are using more and more. The capacity is tight, long lead time.
Bit of a connection issue with Sarah
production.
Malik.
We
I
like
understand
those
we've reconnected now. So Sarah, I'll just pick up and come back because I want you to continue your comment there. We had a comment from Barry about industrial policy in America, reshoring, deglobalization. Is that a thing for you in the chip sector? And I know you like to get stock specific too, so give us some names, the ones you like off the back of that theme.
So we like Intel and Applied Materials. These are companies, they're outside of the U.S. and China trade war. They should actually benefit. Tight capacity, long lead times, complex production. Both of these management teams are amazing. The new CEO at Intel, very well positioned in terms of creating new foundries, and Applied Materials, very shareholder-friendly management team. We expect about a $7.5 billion share repurchases going forward. All of this very positive for semiconductors, which should have this supply-demand imbalance for a while, which is great for pricing and these companies that are very well positioned in the U.S. to take advantage of it.
Barry, I didn't hear you mention the semis. Do you like the chip makers off the back of the thematic story that you described 10 minutes ago?
I do. I've tried to avoid the, as you were intimating, I've tried to avoid the growth versus value story, in part because tech is also a cyclical sector broadly. And when you think about the subsectors within tech, semis is clearly a cyclical sector. We're still in the very early stages of the business cycle. As I articulated earlier, we're recovering not just from the pandemic, but from the trade war, which caused a global manufacturing recession. So I definitely like semis. I actually added to my position in semis this week. And software has cyclical elements to it as well. I know people have viewed that as particularly sensitive to rates, but software investment also softened during the Trump trade war. It should get increasingly strong. The comparables are really tough, but nevertheless, you should have decent fundamental momentum there.
Let's break it down even more, Sarah. The frustration over growth versus value, and I'm guilty of it. I let these conversations slide all the time, and sometimes I do ask, what do you mean by growth? What do you mean by value? When you say tech, what do you actually mean by tech? Let's talk about some names: DocuSign, Amazon, the likes of Peloton. Those companies all do very, very different things, yet we all just put them in a bucket and said stay-at-home stocks, reopening, all the other stuff. Sarah, how unhelpful is it to sit here and have those conversations, growth versus value, reopening, stay at home?
Well, we differentiate between those growth stocks that have higher valuations and lower valuations. There's a lot of quality growth stocks that have had pretty significant declines recently as rates have gone up. They're considered long duration stocks, and people don't want to pay the same level of premium for this bucket of growth stocks. But exactly as you say, you need to differentiate. There are interesting companies out there that are big, like Alphabet, which is in the sweet spot of digital advertising and the cloud. To us, these are companies that you can still own. And then in value, it's very similar. You don't just want to go out there and own any kind of value. Stay away from low quality value. Look for those types of sectors that have also their own levers to pull. So another example is autos. This is a sector that looks like it's going to have a tough time because they're a big user of these semiconductors. But there's a lot of auto companies that are well positioned with low inventory, leverage to trends like electric vehicles and autonomous vehicles. For example, we like General Motors. Large trucks, actually, a big part of their business. Pricing on used large pickups was up 43% year over year in the first half of March. That's a great leading indicator for new truck prices. GM also has a clear strategy on electric vehicles and autonomous vehicles. Another name we like in the auto supplier space, Adient. This is a company that makes car seats. So they are leveraged to all the trends, EV, AV, all the different types of cars that are selling. Also, it's a deep value turnaround, spun out of Johnson Control a few years ago, paying down their debt. A lot of margin upside, very well positioned to continue. They prove that they can get their act together. They beat the first quarter. Adient, we think, is very well positioned for the trends going on in the auto space.
Sarah, it's so nice to talk about these themes and put some names on them and really push through those themes through some individual stocks at the individual name level. And Barry, I want to finish there just on the autos, the EV story that Sarah was describing. Barry, we've spent the morning now, the last hour on this program, talking about growth differentials, industrial policy in America. Do these traditional old school companies that are trying to go new school to some degree play into everything you've described?
They do. I mean, I think that there's no question that the EV trend is real. I think part of the reason why the auto sector behaved so poorly last cycle was the anticipation of a decade or more where EVs just taken almost the exponential market share, or the market share curve becomes exponential. So as these companies demonstrate that they can compete with Tesla, yeah, they ought to have a much better decade. And the demographic story behind them is strong as well. I mean, we had the highest household formation we've ever had, the millennials relative to the boomers back in the 60s and 70s. And so, you know, as we go through this forming households, moving from New York City to Jersey, we sold our house to that sort of a couple when we moved out. to Colorado, that trend is going to persist through the decade. So I think Sarah, hit on a really important point.
Barry, that's the trade you're most happy about in the last year, isn't it? The real estate
no
move you
question
made.
about
I know, I can see it. It's written all over your face. Barry, it's good to see you. Barry Knapp, thank you. Sarah Malik, thank you very much. Please, do not be a stranger. We want to catch up with you again soon. To the market desk we go with your equity market up 0.4%. Here's Taylor Riggs.
Okay, John, last hit of the day for you. Let me try to nail it this time. We're going to crush it. Pull up the travel movers, right? This is so interesting. Finally rising on the day after what was a really tough week. You have American Airlines, for example, rising. The cruise lines is also an interesting story. Remember, the CDC said, we don't care if Joe Biden says we can all party on July 4th. You don't get to cruise until November 1st. The cruise lines are really upset about that, but we are taking it in stride within the equity markets. We change the board. We also take a look at the tanker shippers that are up. We said, what, 20, 30 of the oil tankers are of the 300 that are still stuck. Yes, the Suez Canal is still stuck. The ship is still aground. There is no line of sight for a week, John, to get some movement.
We changed the board. Thank you, Taylor. I've got some bad news for you. You've still got one more hit in about 8 minutes' time. Taylor Riggs, thank you. Coming up, surging Treasury yields weighing on emerging markets, with stocks are raising their yearly advance. A really important conversation with a man I've been looking forward to catching up with, Robert Koenigsberger, Gramercy Funds founder and CIO. This is Bloomberg.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds on the global economic recovery.
I'm Eric Schatzker. Join me for my front row conversation with Soros Fund Management CIO, Don Fitzpatrick.
When there is a dislocation, we're prepared, to not just double down, but triple down when the facts and circumstances support that.
Catch the full front row interview with Don Fitzpatrick this weekend on Bloomberg Television.
You can no longer just bet on liquidity, which has been a wonderful ride. You are going to go through rougher water wherever you invest. There's going to be contagion on the way up, contagion on the way down.
Contagion on the way up, contagion on the way down. What a privilege to catch up with Mohammed Al-Arian of Queen's College, Cambridge, warning of liquidity risks across all assets. Emerging markets feeling the pressure of a steeper curve, sapping risk appetite and wiping out the yearly gains for stocks of developing nations over the last year. For more on that, let's bring in our chief EM credit strategist, Damien Sassan. Morning, Damien.
Morning, Jonathan. How are you, sir?
I'm great, sir, and it's good to catch up with you. The pain in EM, it spreads, Damien.
Yes, it does indeed. I mean, Jonathan, here's what we're talking about. We're talking about funding concerns. I mean, especially in lieu of what just happened with Turkey. We have 38 of 44 sovereign CDS spreads wider on the week. So we had a little bit of contagion, but nothing really. The real concern for me are all these failed auctions. I mean, Indonesia, Romania, Russia, you name it, especially on the local currency side. So, you know, what I'm looking for, which countries have raised cash or ahead of their issuance pipelines, but more importantly, their central banks have enough ammunition to defend their economies in times of crisis.
Damien Sasser on the latest in the EM after a series of rate hikes as well over the last week too. I want to get straight to our next guest, a really important conversation with Gramercy Funds founder and CIO, Robert Koenigsberger, who joins us right now. Robert, let's go straight to this conversation, sir. How the approach to EM has developed and how it's really changed in the last 12 months for you. Can you take it from the top?
Sure thing. Good morning, and thank you for having me.
Thank you.
Look, I think the last 12 months has really proven the importance of dynamic asset allocation within emerging markets. And in the old days, even further back than 12 months ago, it used to kind of be developed markets got sick and developing markets went to the hospital. And it kind of went all up and all down, or risk on or risk off. And what we've seen, you know, in 2020, certainly security selection mattered, dynamic asset allocation mattered, and not thinking about this as a homogeneous asset class mattered. And again, this quarter, you know, with rising rates, one would have thought that, you know, the place you wanted to be was in the highest quality emerging market debt, but that ended up having the most duration and the most interest rate sensitivity. So one needs to be dynamic, and, you know, there's been a lot of discussion about liquidity globally, and I think one needs to think about, are you getting adequately compensated for what could be the lack of liquidity going forward, and what's the right way to bring illiquidity properly into your portfolio and get paid for it?
Robert, that final point I think we need to build on. The lessons learned from March of last year on liquidity and where you'd expect to find it and didn't get it, and how you'd apply those lessons now going forward.
Sure thing. I mean, what we were talking to our investors about in the fourth quarter of 2019, and quite frankly too early in the fourth quarter of 2018, was this notion that liquid markets aren't necessarily as liquid as you think they're going to be. And what we've seen in the last 10 years is the size of the asset class has gotten so much larger relative to those that used to provide liquidity. We have less banks, we have less balance sheet at those banks. So when money comes into the market, there's inelastic supply. There's always an issuer willing to sell a bond at a price. But what happens when you get outflows is you get these dislocations. And so rather than be short the liquidity put, if you will, in liquid markets, at a time like this, we really think it makes sense to lean in on private credit, where you get explicitly compensated for illiquidity, and you get better credit because you structure yourself on a bespoke basis, but you pick up collateral and uncorrelated collateral, and then you wait for the dislocations to happen. The time to bring liquidity into your portfolio is when it's proven to be illiquid, not when you need it to be liquid.
So, Robert, I want to pick up on a couple of things. And one thing I want to pick up on is what you do at Gramercy. You've got to help manage the money. You've also got to lead the firm. The kind of strategy that you're talking about right now, does that require really patient capital to allow you to do what you need to do?
Yeah, I mean, there's two ways that we've accessed it. You know, in the most direct way is what we call capital solutions or private credit. And yes, it takes patient capital in terms of slightly more lockup of capital. I'm not talking like private equity style, like 10 years. But if you're willing to be in 1, 2, 3, 4, 5 year credit, you can explicitly pick up like an extra 1,000 basis points, 10% yield, pick up collateral. And to me, you know, the discussion I have with a lot of our clients is, do you really need all your capital back in 3 days? Because if you don't, the opportunity cost of not getting paid explicitly for a liquid risk in this market is too high. And quite frankly, be careful if you really think you need your capital in 3 days, because as we saw, you know, going back to March of last year, on March 23rd, if you wanted your capital, it was down 15 or 20%.
This allows you to do more interesting things, Robert, quite clearly. One thing you mentioned, one of the things it allows you to do is to go into markets that maybe other people would avoid, but also take on some uncorrelated assets as well. Robert, can you just give me a little bit more color on where you find that right now? Because I think at the moment, this has been a big challenge for people more broadly away from EM. It's where to find the uncorrelated asset at the moment.
Sure. Well, you know, let's talk about Turkey really quickly.
Yeah.
We were talking about that before. You know, in Turkey, in the previous FX crisis back in 2018, you know, yes, sovereign bonds came off and bank bonds came off. But what we found much more interesting is private borrowers that had really good assets that lost liquidity because of the liquidity crisis. And so you could go in and underwrite their business and put a zero value on their business, because that's correlated collateral. But what was really interesting is, you pick up gas stations and you pick up shopping malls and you pick up apartments as collateral that's completely uncorrelated to the business itself. And quite frankly, it's uncorrelated to whether the lira is at 6, 7, or 8, that gas station is cranking out EBITDA or those apartments or what have you. When you're going in at 2 to 3 times over collateralized, there's a lot of room there.
This goes back to time horizon again then, Robert. The time horizon that you would need, the patience that you would need to put these trades in place and to wait. How long do you need to wait?
Well, look, and how quickly does the investor need the capital back, right? Yeah. Because a lot of our LPs are pension funds with long-term liabilities or insurance companies with long-term liabilities. So again, the average loan that we're probably doing is 2 to 3 years. But, we're involved in Mexico. Everybody knows Pemex. A 1-year bond in Pemex maybe pays you 4%. A 1-year supplier financing deal that we do for a Pemex supplier, where we get the Pemex receivable as collateral, and then we get the uncorrelated collateral like we had in Turkey, you can pick up 15, 16, 17%. You're giving up your capital for 1 year. So you're in that Pemex bond for a year anyways. I'd rather pick up the 1,000, 1,200 basis points.
Robert, really interesting stuff. I want to finish on this. We're talking about where you are now. You mentioned potential dislocations in the future. What is the game plan for the next couple of quarters? Because we're set to see some real volatility, perhaps, some inflation-induced volatility in the United States, which could bleed elsewhere. What's the game plan to attack that in the next couple of quarters? What's the dream? What are you looking for?
Look, I mean, the most overused, set of terms on your show has been FOMO and TINA, but it matters, right? So on the one hand, we're thinking of approaching emerging markets with a barbell. Buy this private credit that I've talked about, buy higher quality, high yield that's less interest rate sensitive, and on the one end, so that you get paid well, but that if there's a credit issue, you're well covered. And then on the other end of the barbell is wait for these dislocations to occur. And for us, it's dislocated like we saw in Turkey on Monday morning. It's opportunistic like Argentina today. And it's special situations like litigation finance and things that are always available to us in emerging markets. And then it's tactically moving back and forth, because the difference between March 1, March 23rd, and April 1 in emerging markets last year was huge. So this notion of passively just buying an index makes no sense at all.
Robert, I would love to build on this in the future. Please stay close and don't be a stranger. Really interesting stuff to hear what the firm is up to. Robert Koenigsberger there of Gramercy Funds. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. And your market right now, here's the setup for you as we close out what feels like the longest week ever. We're exhausted, we're almost there. The S&P 500 up 15 points. We advanced 0.4%, a lift in Europe. The DAX up 0.9%. Did you see German business confidence? The outlook, the IFO, much, much better, even with lockdowns. The why? Because Germany wants to export to the rest of the world, and the rest of the world right now looks okay in China and is looking better and better in America. Finish on this in the bond market. Yields have been bleeding higher through this morning. Yields are up now 3 basis points to 166.54 on 10s. I'll run you through the next couple of days and what you need to be looking for into next week with your trading diary next on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance, Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
"25 minutes in, equities up 0.9% on a Russell. We bounced back on a Nasdaq up 0.4%. On the S&P 500 up about 17 points. We advance around about 0.4 there as well. 0.4%, I should say. In the bond market, your 10-year Treasury yield, where are we now on a 10-year? 166.40, there and thereabouts. A break of 160 a little bit earlier this week. 175 last week, all over the place. Didn't even talk about that 7-year supply yesterday. What is it about the 7-year? More about that next week. Let's get you the trading diary. What you need to be watching through the rest of today and into next week. University of Michigan Consumer Sentiment Data coming up at the top of the hour. Tuesday, IMF Managing Director Kristalina Georgieva speaking at the organization's spring meeting. Wednesday, President Biden giving a speech on his economic plans in Pennsylvania. Then we get US construction spending, ISM manufacturing, and initial jobless claims all coming on Thursday. Plus Friday, the US stock market closed, but we will get the payrolls report at 8:30 Eastern. Who planned that? Coming up a little bit later today, 1 p.m. Eastern, Real Yield, George Bory, Vishy Tirupatur, Megan Green, all weighing in on a really interesting bond market. From New York, this was the countdown to the open. Enjoy your weekend. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first
health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. You know, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
So there's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle.
Okay, traders, I'm going to place an order. I want to buy euro. The price I'm looking to buy, 117.80. Okay, 117.80. I'm placing an order. So if you're up to euro, if you want to trade euro against United States dollar, here is your chance. We received the confirmation from our strategy indicator that it's time to buy euro. So please place an order to buy at 117.80. All right, I'll speak to you later.
From rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the...
And I'm going to place an order to buy Swiss franc at 0.941. 0.941, just right here. So if you want to sell short, oops, as you can see, position opened right now. You still have chance because the price moved up. So if you want to trade Swiss franc, here is your chance. Okay, let's see what's happened. We already opened position on Swiss franc. Euro still open. We'll see what's going to happen with next candle stick. If it will move up, I will have to cancel. But with Swiss franc, we're on. Okay, great. I also have to cancel order to buy euro. As you can see, it moved up. So, well, tough luck. We'll have to wait. We'll have to wait what's going to happen with euro. So guys, if you decided to trade euro, let's trade it later, not right now. Please cancel your order. Anything can happen. Don't play hero. Okay, the order to buy euro cancelled.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and he was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression...
Okay, guys, it's time to play stop on profit for Swiss franc. And I am going to play stop on profit at 0.9408. Okay? So let me, I'll show you where. It gives us, in our case, nice 2 pips in profit. In your case, it's all about, again, how much you decided to invest when you started to trade these pairs. So how much broker pays you per pip. Okay? So I place stop on profit, and let's see if it will move, change direction, and if it will move higher, we will not lose any money on this trade. We will end up in profit. If it will move lower, I will see, maybe I will put even lower stop on profit. I mean, in our case, it will be more profit for us. Okay, stay safe. Good trade, guys. Well done. Anybody who follow this trade. If you want to get strategy, you know where to get it from our company website. You can get it from this streamer, as you can see on red line. You can see the website address. All information, how we trade, how to trade. You can use this strategy on different pairs, on CFDs, E-minis, options, on any on stocks. You're welcome to use it. So for other guys who got this strategy, you already know what to do. I'll speak to you later. Position closed, guys, on Swiss franc. As you can see, we made a profit. In our case, it was £200. In your case, again, all about how much broker pays you per pip. Well done, good trade. It took us, how long? 10 minutes. Yeah? Well done, guys. Stay safe.
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped at the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks!
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.